and Sheldon with SMS Capital Management. We're talking with Barry Levinson, who is a founder of Fidelity One Mortgage,
Yes, sir.
residential mortgage broker. Barry wanted to ask you some questions today about people that are dealing with, obviously, getting their mortgages. Let's start with, can you walk us through when somebody's looking to get a mortgage or a refinancing,
Okay.
how does a lender calculate the amount that they will lend to somebody?
Okay, so no, Stephen, thank you for having me. So really what I say, the first thing is that, for someone to call and we can, definitely walk them through them. But in just the general sense for mortgage lending, so what they do is they look at, there's qualifying ratios to see if somebody can afford a home and a loan amount at a certain price. So the simple is the first ratio, which is their total housing payment.
Mm-hmm.
So when they're looking, it's the principal and interest, okay, which would be based on the loan amount, the loan term, and interest rate. So the principal and interest plus
Mm-hmm.
the taxes, insurance, or if there's a homeowners association fee on a condo or townhome, that total payment is called, may refer to as PITI, P-I-T-I.
Mm-hmm.
That number into someone's gross income, okay, is what's called the first ratio, the housing qualifying ratio.
Mm-hmm.
So that's the first thing we look at. The second part would then take their monthly obligations, okay, car loan, if they have other property, those payments, student loans, credit cards, the monthly debt, not so much concerned with balances, but just the monthly debt.
Okay.
You add that to that PITI number, okay, and that's a total, and that into gross income is called the back ratio. That's really the one you kind of focus on more, just that back ratio, that it shouldn't exceed like 43% of gross income, okay? So Stephen, sometimes people will send me a loan application back, and for income they'll put, like their take home. We don't go off take home. So if somebody makes $100,000 a year, we go off that number, even though their pay stub, the net's lower, so it's off gross income.
Off of gross income.
Right.
So you take all those obligations that you described and you put that as the numerator, and the denominator is the gross income, and if that number is
Needs to be about 43% and below, then
that's about how much they could get.
Yeah, and really there's people, sometimes they'll say, I want my housing payment, kind of want to spend X amount. The 43%, that's quite a bit of their gross income. It's almost half. So that ratio is really kind of pushing the envelope some. Which some people, they want to, try to get as much house as they can. Some people say, I'm looking to keep my payment at so-and-so, we travel, we go out, which, then they want that number to be a little bit lower.
So when somebody's getting a new mortgage, either because they're looking to refinance or they're going to be buying a new home, what are the key things they can do to make that process smoother and get the best rate possible?
Okay. The first thing is really credit. Credit scoring's huge in getting what's secondary mortgages, what you people have heard of like Fannie Mae or Freddie Mac, or even if their loan's over 424, a jumbo loan, then credit and credit scores are important. So if somebody has not, some people through their credit card or have credit monitoring, some people know what their credit scores are. This day and age with security and, fraudulent stuff, some people are really on top of it. Others really haven't pulled credit in a while, really wouldn't know. So I every single year somebody should go, it's like www.annualcreditreport.com to get a copy of your credit report and your credit scores just to see where you're at. If your credit scores are on the lower side, there are some stuff you can do, to raise them, decrease balances on credit cards. There may be some derogatory credit, okay, that maybe isn't yours or you aren't aware of.
Try to clean all that up.
It's to get it cleaned up, and really you want your credit score as high as possible because there are limits in terms to get the best rate.
Okay.
So looking at your credit report first. The second thing would be for your money, okay? Money that you have in savings, checking, brokerage. Try not to move it around a lot. I know there's sometimes people, they get kind of more focused and some really get obsessed that getting the best rate of return or best interest rate, and they'll just move it from one to the other. So when you're doing a loan, it becomes, when money's moving around, they want to know where it came from. So kind of keeping money, especially more, let's say if you're buying a house, really kind of putting all your money in one account. Okay, so even if you're, adding or supplemental, from husband and wife, a little bit from their paycheck or whatever, put it in one account and let that build over a couple months. Because when you're doing a loan, you want the current balance and the average balance to be as close as possible.
So you're doing streamlining all of your kind of funds.
Yeah, they
flow,
don't need
your
to
personal
move.
funds.
They don't need to move them around.
Yeah.
It's just that while you're either looking to refi or purchase,
Right.
try not to move money
Not
around.
a lot of activity. And is
Yeah.
it with it? Do they look back a few months or a
But
year?
it's over 60 days.
60 days.
So
Okay.
if somebody has like a big deposit, or it's not the end of the world. You just got to document where it
Okay.
came from.